I'll just say that when we use the phrase stagflation, we're immediately talking about the 70s. And stagflation in the 70s had one more piece to it. It wasn't just whether you had high inflation and lower growth. It was inflation expectations getting out of whack. And the reason Volcker and others had to do so much about stagflation was that expectations were out of whack. So far, at least the market measures are in good shape. We've obviously gotten some negative numbers from the Michigan survey. That's something to watch very closely. But my belief is as long as the Fed does what we need to do, you'll keep expectations in shape, and therefore you'll keep the medium to longer term stagflationary impulses out of it.
So this does not qualify to you in the current form that this is stagflation now, and which you could make the argument is the Fed's worst nightmare, because what do you do in that scenario?
Well, what we're seeing right now, actually, the data is still in the game of okay. And so all of this is about forecasts, and we'll see what the forecasts go. I do think that there's a risk on the employment side, and Rob was suggesting some of that. The way I think about it is if businesses pass on tariffs, then that's good for them. It's inflationary, right? It hits prices. It also is going to hit volume. So higher prices, lower volume, that's going to have issues on the employment side. If they don't pass on tariffs, then lower prices, that's good for inflation, but, you're going to have margin squeeze. And if you have margin squeeze, that's also not good for employment.